A strange thing happened over the last few years. Not a war, not a financial crash, not a dramatic diplomatic split. Something much quieter. Countries around the world started trading less with the United States, not necessarily in absolute terms, but in relative importance. And because it happened gradually, almost nobody treated it as a major story. Yet when economists, central banks, shipping companies, and trade ministries started looking at the numbers, they noticed a pattern. The global economy was beginning to rearrange itself. That matters because for decades, the United States occupied a unique position. If you wanted access to capital, technology, consumer demand, financial services, or international markets, America sat somewhere in the middle of the equation. Even countries that disliked Washington's foreign policy usually depended on American markets in one way or another. Today, that assumption is becoming weaker. Not gone, just weaker. And sometimes the biggest changes in history don't arrive with headlines. They arrive through thousands of small decisions made by people who never intended to change history at all. A manufacturer in Vietnam chooses a new supplier. A bank in the Gulf settles a contract in a different currency. A Brazilian exporter signs a long-term agreement with an Asian customer. Individually, these events are boring. Collectively, they tell a very different story. Because this isn't really about whether America is declining. That debate usually produces more heat than light. The more interesting question is why so many countries are building alternatives at the same time. Why are governments investing in new trade corridors? Why are regional trade agreements multiplying? Why are countries that once relied heavily on a single market suddenly looking for backup options? The answer starts with a lesson many governments learned during the last decade. Dependence creates vulnerability. The COVID-19 pandemic exposed supply chain weaknesses that few policymakers fully appreciated. Factories stopped, ports clogged, shipping costs exploded, critical goods became difficult to obtain. Then came sanctions, export controls, technology restrictions, energy disruptions, and geopolitical tensions stretching from Eastern Europe to East Asia. Governments watched all of this unfold and reached a similar conclusion. No matter how friendly a relationship appears today, excessive dependence on any one country can become a problem tomorrow. That realization changed behavior. Notice something important here. Many countries are not replacing American trade because they suddenly dislike America. In fact, many remain close security partners of Washington. The shift is happening because diversification has become a national strategy. It's the economic equivalent of not keeping all your savings in one bank. You hope nothing goes wrong. You prepare anyway. This is why trade flows have started spreading across multiple regions at once. Southeast Asia has become increasingly connected to China, India, Japan, South Korea, and the Middle East simultaneously. Gulf states are deepening links with Asia. African governments are pursuing regional integration projects. Latin American exporters are expanding customer bases beyond traditional destinations. The old model concentrated activity around a handful of major centers. The emerging model looks more like a network, and networks behave differently. Here's where things get interesting. Many analysts still view global trade through a Cold War lens. They imagine countries choosing sides, aligning with one bloc and reducing ties with the other. But much of the world isn't behaving that way. Countries are increasingly trying to trade with everyone. India wants stronger ties with the United States while expanding commerce with the Middle East and maintaining relationships across Asia. Saudi Arabia seeks Western investment while building deeper economic links with China. Indonesia welcomes multiple partners rather than committing exclusively to one camp. The goal is flexibility. And flexibility has become one of the most valuable assets in international economics. There's a slightly amusing irony here. For years, globalization was supposed to create a deeply interconnected world. It succeeded so well that governments eventually became nervous about how interconnected everything had become. The response was not isolation. The response was diversification, a subtle difference. But that difference may end up reshaping the global economy more than most people realize. Because once countries start building alternative trade routes, alternative payment systems, alternative supply chains, and alternative partnerships, those structures don't disappear overnight. They develop momentum. And the deeper question isn't whether America remains powerful. It almost certainly will. The question is whether the rest of the world has quietly started building a system where American power matters a little less than it used to. To understand why that process accelerated, and why even some of Washington's closest partners joined it, we need to go back to a series of decisions that changed how governments think about economic risk. The turning point wasn't a single event. It was a series of shocks arriving one after another, each teaching governments the same lesson from a different angle. The pandemic exposed supply chains. The Russia-Ukraine war exposed energy dependence. Technology restrictions exposed industrial vulnerabilities. Together, they forced policymakers to ask a question that would have sounded paranoid 10 years earlier. What happens if our most important economic partner suddenly becomes unavailable? Not permanently, just long enough to cause damage. That question changed investment decisions everywhere. Take Southeast Asia. For years, many multinational companies built production networks centered around China. The logic was obvious. China had scale, infrastructure, skilled labor, and manufacturing ecosystems that few countries could match. Then, companies began looking for insurance policies. Vietnam became a major beneficiary. So did Thailand, Malaysia, and Indonesia. Manufacturers didn't necessarily abandon China. In many cases, they added another location alongside it. This distinction matters. A lot of headlines describe this as companies leaving China. The reality is usually more complicated. Many firms adopted what executives started calling China plus one. Keep production in China, build additional capacity somewhere else, reduce risk. The result was a new map of trade. Factories expanded across Southeast Asia. Supply chains stretched across multiple countries. Components crossed more borders before reaching consumers. And once those investments were made, they created their own momentum. A company that spends billions building facilities doesn't wake up one morning and decide to move them again. Trade routes become sticky. That's one reason the global economy is starting to look different. But supply chains are only half the story. Money tells an equally interesting tale. For decades, the US dollar sat at the center of global commerce. It still dominates international finance today, and predictions of its immediate collapse are usually more fantasy than analysis. Yet something smaller, but still significant, is happening beneath the surface. Countries are experimenting. Brazil and China have expanded mechanisms allowing portions of trade to be settled directly in local currencies. India has explored rupee-based settlement arrangements with various partners. Several Gulf nations have discussed conducting more transactions in non-dollar currencies. Notice the wording, not replacing the dollar, reducing exclusive dependence on it. Those are very different things. One is revolutionary, the other is practical. Governments are not trying to burn down the existing financial system. They're trying to build additional exits in case they ever need them. Think about it this way. If a city has only one bridge, everyone becomes nervous when traffic increases. Build a second bridge, and nobody assumes the first one is collapsing. They simply feel safer. That mindset is spreading across international trade. And perhaps the most overlooked example comes from the Middle East. For decades, many observers viewed the region primarily through the lens of oil exports. Today, Gulf countries are pursuing something much larger. Saudi Arabia, the United Arab Emirates, and others are investing heavily in logistics networks, ports, industrial zones, data infrastructure, and transportation corridors linking Asia, Africa, and Europe. Their ambition isn't merely to sell energy, it's to become indispensable trade hubs. A shipment moving between continents increasingly passes through locations that want to sit at the center of multiple economic networks simultaneously. Not east versus west, both. That strategy is proving surprisingly effective. Meanwhile, another development receives less attention than it deserves. Regional trade agreements are proliferating. The Regional Comprehensive Economic Partnership, or RCEP, brought together major Asia-Pacific economies into the world's largest trading bloc by population. Members include China, Japan, South Korea, Australia, Indonesia, Vietnam, and several others. Something remarkable happened there. Countries with political disagreements decided economic integration was still worthwhile. That sounds obvious. It isn't. Historically, geopolitics often disrupted commerce. Increasingly, countries are trying to separate the two when possible, not always successfully, but often enough to matter. Remember the question from earlier? Why are countries quietly reducing dependence on a single economic center? Because they watched disruptions multiply, and they concluded resilience was worth paying for. That doesn't mean America's influence is disappearing. Far from it. The United States remains one of the world's largest consumer markets, the leading destination for global investment in many sectors, and the home of financial institutions that still shape international capital flows. The counter-argument is strong. Many economists would correctly point out that American economic power remains enormous. I agree. But that observation misses something important. The story isn't about America becoming weak. It's about other countries becoming less dependent. Those are not the same thing. And once you understand that distinction, a lot of seemingly disconnected developments start fitting together. The new factories, the new trade corridors, the new payment arrangements, the new regional agreements. They're all responses to the same underlying calculation. Governments are paying a premium today to avoid being cornered tomorrow. The surprising part is where this logic leads next, because the biggest challenge to American trade dominance may not come from China, Russia, or any rival power at all. It may come from a world that increasingly prefers having multiple options. There's a complication here that almost everyone misses. The countries reducing dependence on American trade are not creating a replacement system. They're creating a backup system. Those sound similar. They're not. A replacement implies somebody takes America's place at the center. A backup system means there is no single center at all. And that's where the story becomes much harder to predict. Because despite all the headlines about China's rise, Beijing faces limits of its own. China's property sector has struggled. Demographics are becoming less favorable. Foreign companies remain cautious about regulatory risks. Several governments are happy to trade with China while remaining deeply uncomfortable about becoming dependent on it. In other words, many countries are trying to avoid replacing one dependency with another. Remember the trade diversification we discussed earlier? It cuts both ways. A government that worries about over-reliance on Washington often worries about over-reliance on Beijing too. India is a perfect example. Its trade with the United States has grown substantially. At the same time, India continues expanding economic relationships across Asia, the Middle East, Europe, and Africa. New Delhi isn't choosing a side, it's collecting options. That approach is becoming surprisingly common. Which brings us to a statistic worth thinking about. According to data from the World Bank and IMF, the United States still accounts for roughly a quarter of global GDP. That's enormous influence. No serious analyst should dismiss it. Yet America represents only about 4% of the world's population. The implication is straightforward. Many countries see future growth opportunities beyond any single market, simply because most future consumers will live elsewhere. That's one reason trade routes connecting Asia, Africa, and the Middle East are attracting so much investment. The biggest shift may not be who dominates global commerce. It may be where future demand comes from. And here's the reversal. For most of this video, we've discussed countries quietly reducing dependence on American trade. But American policy itself may have accelerated the process, not because Washington wanted it, because Washington had different priorities. Sanctions, export controls, tariffs, and technology restrictions were often designed to achieve national security objectives. From a strategic perspective, many American officials would argue these measures were necessary. That's a legitimate argument. The problem is that other countries were watching. Every new restriction became a reminder that economic relationships can be used as geopolitical tools. As a result, governments started searching for alternatives, not necessarily because they expected confrontation, but because they wanted insurance. That's the unintended consequence. The same policies designed to strengthen American strategic leverage encouraged others to reduce their exposure to it. One short sentence changed a lot of thinking, just in case. Those 3 words now shape trade ministries from Jakarta to Riyadh. My view is that we're entering a world where economic influence becomes more distributed rather than transferred. The next decade won't belong exclusively to Washington, Beijing, Brussels, or New Delhi. It will belong to countries that successfully connect all of them. And that leads directly to the biggest question of all. If nations no longer want a single economic center, what happens to a global system that was built around having one? The irony is that America may remain the most powerful economy in the world, while simultaneously becoming less central to how the world trades. Those two things can be true at the same time. For decades, global commerce resembled a wheel with a dominant hub. Trade, finance, technology, and investment often passed through the same few centers. That model delivered enormous efficiency, but it also concentrated risk. Today, governments are building something different, not a rival system, a more distributed one. Look at the projects being funded across the world: new ports in the Gulf, manufacturing corridors in India, industrial parks in Vietnam, rail connections across Central Asia, digital payment systems linking countries that barely traded directly a generation ago. Individually, these developments seem unrelated. Viewed together, they're part of the same story. Countries are preparing for a future where flexibility matters more than allegiance. And that's why the title of this video is slightly misleading. Countries are not quietly replacing American trade. They're quietly replacing dependence. America just happens to be the largest dependency many of them had. That distinction changes the entire interpretation, because if this trend continues, the winners won't necessarily be the biggest economies. They may be the economies that can connect multiple regions at once, adapt quickly, and avoid becoming trapped inside someone else's geopolitical strategy. My prediction is that by the mid-2030s, the global economy will look less like a pyramid and more like a web. The United States will remain a critical node. China will remain a critical node. India's role will grow substantially. The Gulf states will become more influential than many analysts currently expect. And several middle powers, countries that rarely dominate headlines today, will find themselves holding far more economic leverage than they did 20 years ago. The question isn't whether America can stop this shift. I'm not sure anyone can. The forces driving it are larger than any single government. They're rooted in risk management, demographics, technology, and the simple desire of nations to have options. History suggests countries rarely volunteer to become dependent if they have alternatives. They're building those alternatives right now. Quietly, patiently. One trade deal, one port, one factory, and one payment system at a time. Which brings us back to the observation from the beginning. The biggest changes in history often don't announce themselves. They accumulate. Then one day people look around and realize the world operates differently than it did before. We may be living through one of those moments, and by the time everyone agrees it's happening, the transition will already be well underway. If you enjoyed this analysis, subscribe for more deep dives into the forces reshaping economics, technology, and global power. There's always another shift happening beneath the headlines.